What's up, everyone? It's Karthik with MoneyVest. So let's talk about Enphase stock. A lot of you have been asking a lot of questions on this company, so the time has come to finally do a deeper dive, a full analysis on Enphase as a solar energy company. We're going to be going over a deeper dive in terms of what the company actually does, their flagship products, how it compares to some of the competitors out there, why it's been selling off so aggressively, and if there is any opportunity with Enphase moving forward as well. So hope you all enjoy this video and find it helpful. If you do, make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available until the end of this month. So just a few more days left if you want to lock in that price and also capitalize on the annual discount. Save 2 months, so 2 months for free. You get access to the MoneyVest website, the trade alerts, the options portfolio, all the members only videos, everything included with the link down below. So again, check that out. I am sure you're going to find a lot of value. So looking at Enphase stock, trading down to $91 per share. The stock is down significantly from its all-time highs of well over $344 per share. It is down over 73%. So significant amount of selling pressure. And more recently, of course, it's been selling off 3 consecutive weeks in a row. Last week, it was down over 9%. Again, a lot of consolidation sideways in that range. So if I remove for everything here, really the two prices that we're really watching for Enphase, one over here at 136, that seems to be a very strong area of resistance. And then we had a little bit of a support right about there at $95, $96, so pretty much low 100s, high 90s. And it's now starting to break down a little bit further. And the next most obvious support, of course, is going to be sitting in the low 70s. But let's talk a little bit about what Enphase Energy does, their flagship products, and how it compares to their competitors, and what's going to be the future really for this company moving forward. So as we already know, that Enphase Energy operates in the solar energy space, renewable energy space. They don't really produce the solar panels, but what they do create are batteries, microinverters, and grids. So we've got the IQ8, which is their flagship product, which is their best-selling product, which is the IQ series of micro inverters. And what they really do is that instead of having one big inverter for their technology, so basically whatever the DC power direct current solar panels collect, and then wire it down to one big inverter for converting it into AC, which is the alternate current that we use in our homes. What Enphase does and the technology that it has is basically microinverters. So every single panel is going to have a microinverter attached to that panel, which of course comes with a 25-year warranty. And that is how they convert that DC power to AC power, and then of course sending it to their battery packs, which then powers the entire home. So they again use the concept of microinverters, which can be seen over here. This is more of a traditional inverter where if there is, let's say, one single panel under a shade, or there's damage, or there's snow, the entire solar system starts to fail in terms of that efficiency and performance. But with Enphase, what they do is that with the help of this microinverter, even if there's one solar panel running on low efficiency, it doesn't really affect all the other panels because every single panel has their own microinverter to work with. So basically, Enphase uses microinverters and is able to mitigate the impact of shading, damage, whatever the case might be at the module level. And on a more traditional big inverter, a shadow on just one panel can reduce the performance of the entire system. But with Enphase using microinverters, only the shaded panel's output is affected, allowing for other panels to operate at peak efficiency. And I think this is one of the biggest reason Enphase is really loved so much, is because of the efficiency and the power it provides on a more granular level. A lot of the other competitors, including the Tesla Powerwall 3, uses a technology something like this, where they do lay out all the solar panels and they have one big microinverter, or essentially inverter, which converts the DC over to AC. But Enphase using this technology is what separates them, giving them a little bit of an advantage when it comes to the overall technology piece. However, when you compare the battery packs, there's a huge difference, which we'll go over later in the video as well. So advantage-wise, there is independent operation of each individual solar panel. Each microinverter connected to each panel converts the DC power to AC power at the source, and that means if one panel is shaded, dirty, or damaged, it won't drag down the performance of other panels. And this setup maximizes efficiency and also ensures steady power production and safety as well. And you can also see how each individual panel is performing in real time through Enphase's app, which also provides incredible amounts of insight and detail into maintaining the longevity and performance of the entire solar system as well. And also, the microinverters can also create their own microgrid, which is crazy because they can power essentially a lot of the appliances that are within the house. Again, most of the essential appliances if there's an outage, and can sometimes also function without a battery as well. Now, Enphase also sells a battery, which is their IQ 5P battery, which compares to the Tesla Powerwall 3. And Tesla Powerwall 3 is clearly the sort of the better battery, so to speak. However, Enphase, with their application and also providing a lot of efficiency in the way that they actually function with their microinverters, definitely gives them the quote-unquote X factor, which I've also discussed in one of my previous videos. So this really is, a discussion based on more situation. There is not going to be a fair comparison because of the different product types, different technology. Even though both of these battery packs are using the lithium phosphate technology, both of them are using different types of conversion of the electricity, the solar, energy coming in to electricity. So it's a different sort of technology of conversion. But the battery pack, of course, we can compare, where Tesla clearly has the lead in the Powerwall. But like I said, Enphase does have that X factor of the microinverter technology, making them more efficient on a more granular and more specific level. So 5 kilowatt hours of battery capacity for the IQ 5P battery. So you really have to stack up 3 batteries against one Tesla Powerwall 3, because that has a 15 kilowatt hour of battery capacity. When it comes to power output, we're looking at 3.84 kilowatts, which is 16 amps or 240 volts per individual battery unit, which again is going to be significantly lower than the Tesla Powerwall 3, which is over 11.5 kilowatt of power output. 15-year warranty for Enphase, 10-year warranty for Tesla. Tesla uses one inverter, like I said, and again, Enphase uses the microinverter technology, which is going to be more significant in terms of the advantage that it actually sets it apart from the competition. And like I said, it's going to be more of a situational based discussion depending on your needs, depending on your energy needs. It really comes down to what are you looking for. And when it comes to the cost and the value, after the 30% tax credits, you're looking at anywhere between $10,000 to $12,000 for the Enphase IQ 5P battery. This is not including for the microinverters, and the Tesla Powerwall can run anywhere from $7,000 to $10,000 as well. So slightly cheaper after the tax credits, and it also has a little bit of a switch that comes with this Tesla Powerwall as well. And again, both of them have significant amount of applications. You can pretty much track a lot of different things and gather a lot of insights into your energy usage on those applications and how to make it more efficient, and again, run it a little bit faster or longer than what's usually available from a traditional source. So a traditional grid, so to speak. Now, coming over to the actual fundamentals for the company, you can see the M score is at 3.77. So in my opinion, Enphase continues to have a pretty decent moat for the long term, but some of the challenges it has faced over the last 3 years, you can see the stock price has literally just been coming down, is because of the higher interest rates, poor sell-through rates, and because of the inventory piling up significantly, and we're seeing revenues and earnings and profitability, everything starting to really come down for the company. Because if you come over to fundamental analysis more specifically, and again, there's a lot of reasons as to why that's happening. Higher interest rates, it becomes very, very difficult to really finance these types of solar panels and these solar systems, because they can cost thousands of dollars. So people are really going to start pulling back, because ever since interest rates started going up, you'll notice Enphase stock started going down, because we had the revenue, and like I said, the profitability, the margins, everything really started to come down, pretty much get cut in half. If you come over to the last 12 quarters, for example, come over to revenue, there's been a clear decline post 2023, right? So 2023 was pretty much the peak for the revenues, well over $600-700 million in revenues, and of course, we started to see the impact of a lot of inventory buildup. Higher interest rates, sell-through rates were not coming in very strong from the third-party providers and suppliers of their microinverters, and as a result, we did have this significant drawdown in the overall revenues, and now we've started to stabilize a little bit of those revenues in the $200 to $300 million range for the company as well. If I plot for, let's say, gross profit, a very similar trend, you'll notice, kind of peaked out in 2023, and since then it's been coming down, kind of stabilizing a little bit here in the 115 to 125, 130 range for the gross profit. And the biggest reason why we've seen such a massive exodus of Wall Street, for example, is because of the net income. So if you come over to the bottom line profitability, we really see profitability getting shattered for the company, from going from $160 million, and just 2 quarters later, we're down to net losses of $16 million. I did a video about this in the past as well. And last quarter, of course, the quarter ending in June, we did see that profitability climb back up to almost $11 million. And what's really the reason? If you come over to, let's say, research and development expense, selling general administrative expense, and really just plot for total operating expenses, that's been relatively flat, right? So if you have revenues coming down and gross profits coming down, but expenses are relatively flat, right? So if I, let's say, replot the selling general administrative expenses, you'll notice that it's been relatively flat, right? We're looking at 81, 82, $85 million in SG&A. R&D, $45 to $50 million. So you've got expenses that are relatively flat, revenue, gross profit coming down. It's obviously going to be hurting your bottom line, which is one of the biggest reasons why Enphase stock is performing so poorly, because institutional investors really don't care about what the long-term vision looks like. Even though long-term Enphase and even Tesla energy, sort of sector has a lot of potential as the world kind of heads into that direction of renewable energy. However, short-term, it's still under a lot of pressure because of the lack of profitability. Now, what's going to happen post 2024 as we're starting to see the quarters turn back towards profitability? We're nowhere near close to where we used to be, but we are finally starting to kind of stabilize in that area. So if you come over to analyst estimates, you've got buy ratings, of course, with 23 buy ratings, 17 hold ratings, and 2 sell ratings. Lowest price target of $76, average $129, and a high target of $178. And if you come over to the annual numbers for earnings per share, this is also one of the reasons why Enphase has not been performing well, because earnings per share estimates have really come down from $3 last year to just about $2.61. That's going to be a 14% decline on a year-over-year basis. If you come over to, let's say, TradingView's analysis of earnings estimates, again, on an annual basis, you'll notice going from $441 down to $251 for the company. They're also reporting earnings in the next 4 days. So that, again, is going to be a huge decline. And it's really this growth right here, right? So even if you come over here, you'll notice 261 up to 489, 579, 766, 952, all the way up to $11, right? That is where the growth is going to accelerate back up for Enphase. And we're looking at about 87%, 18%, 32%, 24%, 12% growth expected on a year-over-year basis. And on a compounded basis, we're expecting anywhere from 18 to as much as 20% on a more longer-term basis for Enphase Energy. Of course, these are still expectations at the end of the day, so you want to be a little bit more conservative. What if Enphase takes a little bit longer to reaccelerate that profitability back up? So you want to be going with some conservative numbers. We'll talk about the intrinsic value shortly. And revenue is also coming in at 2.2 billion. You can see that it's coming down to 1.4 for this year. That's a huge decline of 37%, right? Pretty much getting cut in half almost, and then accelerating back up to 2 billion, 2.4, and they're really eclipsing some of those peak highs that we saw back in 2022, 2023, getting up to over 3 billion in 2027. So it really is a interesting dynamic where we had Enphase accelerate its business during the COVID boom. We had significant amount of revenues, insane amount of profitability, great margins. It kind of peaked out in 2023. Interest rates started going higher. Energy demand started to come down. And then as a result, we saw significant pull down on the overall revenues and margins. The reason being is because, of course, they had significant amount of payroll, S&G, R&D, again, everything pushed up. Expenses were relatively flat, revenues coming down, and the company got pushed down to net losses. And that is really where it's going to stabilize a little bit now, and then that acceleration is going to come back in. So that's the real question, is that post-2024, can we then start to see some growth in the top line and the profitability once again moving forward? Of course, time will tell, but if you take a look at Enphase and where it's trading at the moment at $91 per share, and let's just do some very, very basic analysis of the company, right? So if you come over to the Analyzer tab, we're going to come over to the discounted earnings multiple, autofill. So last year, they did revenues of well over 2 billion, of which profit was 438 million. I just want to confirm those numbers here. So coming over to the MoneyVest metrics here, we've got high growth across the board, 2.2 billion, and net income was $438 million. However, this year, it's going to be more like half of that. So if you come in and we analyze, let's say $250 million, right? That's going to be that number for net income. So 250 is what we're going to plug in. And let's analyze for the next 5 years. Of course, analysts are pricing for 18 to 20%. Let's just say that we're going to go for 16% growth. This is post 2024. We're also going to compare the earnings per share numbers with our own, with the analyst expectations and the PE multiple, right? So if you really take into account where Enphase is trading at the moment, if you come over to the analyst estimates, you'll notice based off of 2024 EPS of $2.61, we're looking at 35 times earnings multiple, which one would argue is still really high considering that the earnings are going to decline this year. And that number is going to drop down to 18.7 fairly quickly if earnings accelerate back up in 2025 to over 87%. So that's, again, a pretty significant jump on a year-over-year basis. So let's say that we're going to apply a 25 times P multiple for Enphase, growing them at 16 to 18%. With a earnings, with of course a net income of about $250 million for let's say this year. So 5 years, we got about 16%. We're going to apply 25 times P multiple. Share dilution has also been very, very high, but more recently though, it's been a lot lower. So if you come over to the more recent quarters for statistics and again, quarterly numbers, we're just going to plot for shares outstanding. It's in fact been going down from 137 down to as low as 135 now. So a couple million shares bought back in the last couple years, and for the right reasons, because the stock is trading pretty cheap relative to where it could be over the long term. So we're going to apply, let's say, a minus 1% share buyback, 10% margin of safety, 12% discount rate. If we hit calculate, we arrive at a fair value, which of course is significantly lower than where we are. And that's primarily because of the cut down in the net income for the business. However, if you take a look at the See More page and you look at the earnings per share, we're only really growing up to $4 by the year 2029, which is not going to be the case according to analyst estimates. So we are extremely conservative here in this expectation, in these estimates here. So if I go with, let's say, a 25% growth rate, that's what analysts are pricing in, and AP multiple closer to 30, which is still a multiple compression, but it's going to average it out because of the higher growth rate expected post 2024 when interest rates are lower, and we see again a little bit more of a higher adoption for the solar panels and the microinverter technology, and again the battery packs. If you calculate now, we're looking at a stock which is really at fair value at close to $90. But like I said, this is dependent on this idea that post 2024 there's going to be a very strong recovery for the business. In other words, the worst is behind us for Enphase, and we're going to start seeing the revenues, the gross profit, and the bottom line net income start accelerating back up. And you can see that this is more aligned with what analysts are also pricing in for, because EPS down to $6 per share, right? With the forward P multiple, of course, coming down to 15, and the fair value sitting at $90 or something, $90.76, and the future target price of $177 in 5 years. And remember this number, 592, 5 years from now is going to be 2029. So if you come over to analyst estimates here, right about there, 2029, they've got a price target well over $10.72. So I'm even going more conservative, and the stock price pretty much is at fair value. But as I said, there's a big wild card, which really nobody knows how strong is going to be that recovery for the solar sector, right? Because if you take a look at a lot of other stocks, FSLR, which is going to be for solar, it has been selling off more recently, so 3 consecutive weeks of red. However, not as bad as performance compared to Enphase, and year-to-date basis up still over 17%. If you take a look at Solar Edge, again, absolutely getting collapsed here, just selling off to extremely low levels and pretty much hitting 52-week lows every single day. Year-to-date down over 81%. For its all-time highs, this stock is down over 94%. So definitely, the solar sector is under tremendous pressure right now. Enphase, on the other hand, we got a support level now sitting at $73, $74. And so for me, I don't mind selling puts in the low 70s for Enphase. So that right there is going to be a level where I would be watching. So if you come over to, let's say, ENPH for puts, and you go over to the options chain and look for puts for, let's say, next week, or November 1st rather, $70 puts are going to be sitting roughly at around 38 cents, but even in the 75, 85 cents per contract, $80 is going to be $1.43. So really, this is going to be what I would be looking at, because that is a very strong area of support. It's going to offer some decent return on collateral, which analyzed could still be pretty strong returns for Enphase. So I wouldn't mind starting a little bit of a position here at that next support, considering a pretty decent breakdown for Enphase at the moment. So let me know your thoughts down in the comment section below. And again, if you try to spin the analysis a little bit differently, if you come over and do the autofill feature, if you were looking at net income, which was pretty much last year's net income, growing them at 20%, giving them a 25 times P multiple, no share dilution. If you hit calculate, you may arrive at a stock that might be undervalued already by 12%. But of course, we're not going to be working with this net income here because of the significant cut down in the overall profitability on a year-over-year basis. So if you come down to 250 now, then of course your fair value is going to come down dramatically, again, 30 to 40% down in the low 50s or 60s. So it really is a understanding of what that recovery is going to look like post 2024 for Enphase. And one more thing that I wanted to point out is that if you come over to the balance sheet for the last, let's say, 12 quarters, and you really just plot for inventories, you can see how that inventory buildup has been increasing because of the lack of sell-through rates for their microinverters. So that is something that they have to get out very, very quickly. They have to start selling these fairly quickly in that post 2024 recovery so that we can actually start to see new products come out, new innovation, new technology. And as a result, Enphase can have some hope of that recovery back up, considering there's a lot of consolidation happening with both the profitability and margins at the moment. So hope you all enjoyed this video and a complete update on Enphase. Support level right now is going to stay put at $73, $74 per share. Right now we're seeing a little bit of a breakdown, so I'll be looking at selling puts in the mid 80s to low 80 range, or maybe even in the mid 70s for some decent premiums for a couple of weeks out, maybe a month out. We'll decide, and again, I'll send out all the updates in our Discord for the options portfolio as well. Make sure that you drop a like, subscribe to the channel, let me know your thoughts down in the comment section below. And as always, happy investing. I'll see you all in the next video.